in the last decade, we've seen this rapid growth of what we commonly call the private financial markets. And right at the outset, I'm going to sort of quote around private, because when we say in finance, public and private, it can be really confusing, right? Because by public, we don't mean governmental, right? We don't mean public in the sense of this is, like a public institution that's led by a democratic government, right? We mean public in the sense of open financial markets that are available to anyone versus the type of financial markets that we're talking about today, the sections of the financial market that are really limited historically to a certain segment of the investing public. But we've seen in the last decade this growth in what I often refer to as unregulated or lightly regulated finance. This is the part of the financial markets that does not trade on open exchanges such that anyone can buy in. And it's been growing incredibly rapidly. We're probably most familiar with private equity. We've had a lot of conversations and campaigns and policy interventions around private equity over the last many years. And now we're here to talk about private credit funds, which are a related type of institution. But it's useful to get an overview of this whole structure of the financial system to understand how private credit funds fit in. So for nearly 100 years, we've had this division in our economy between regulated banks and exchanges, financial exchanges, stock markets, and private markets, these limited markets, to protect ordinary households and the broader economy from the risks that financial actors take when they don't have to disclose what they're doing, right? There's a lot of risk that can build up when you can take all kinds of activity as a financial institution and don't have to share what you're doing with the public. What's so important right now is that this barrier between the public and private, or the open and closed or less regulated sides of the financial market, this barrier has collapsed. And so unregulated finance is flooding in to touch all sectors of our economy, non-financial corporations, our own retirement savings, public pension funds, all kinds of institutions. But why did we have this barrier, this distinction in the first place? It's because of the economic catastrophe of the Great Depression, right? So to take us all the way back to 1929 and through the 1930s, we had, of course, a major financial and economic collapse. And there was a lot of work at the time that went to, really the first time we built up major financial regulatory institutions. We can talk about this in the Q&A if people are interested, but we have a whole set of what we can think of as our New Deal financial regulations, the Securities Acts, the Investment Company Act, Investment Advisors Act, that really in different ways institutionalize this public and private divide in the financial markets. And, just to be a little bit repetitive, the point of it was to establish this highly regulated public realm and then this lightly regulated private realm based on the premise that if you're going to have these open public markets, you have to give the people who are going to be putting their hard-earned money into these markets detailed disclosure of financial activities by non-financial corporations and by financial institutions. Private markets were assumed to be the domain of wealthy expert shareholders, so they did not need all that disclosure, right? The accredited investor has to be definitionally wealthy in order to engage historically in the private markets. So just to say what we traditionally think of as the public markets are the stock market, the New York Stock Exchange, the NASDAQ, and the regulated banking system, right? We've had so much work that we all put in around Dodd-Frank to put in place new kinds of regulatory structures around the banking system after the collapse that we had in the 2000s, right? But that barrier, still stood. What I've been really concerned about, and I think why many of us are really concerned about right now, is the fact that the center of gravity in finance has shifted in the last 10 years to be much more centered in these unregulated or private financial markets. So private funds, which I'll define in a second, have approximately tripled in just the last decade to hold $26 trillion of gross assets, up from $10 trillion in 2015. This is according to the Securities and Exchange Commission. So this is a huge jump, right? And I think we still live in a world where we think, okay, most finance happens in the regulated financial markets, and over here there's these alternatives. They're maybe pretty risky, but they're not going to affect most people. And I think what's happened is because this barrier has fallen, we have to be so much more concerned about what the risks that's happening in the private side of the financial markets, how those could affect all of us, right? Why did this happen? The shift really began in the aftermath of the financial crisis and escalated very, very quickly. It was due to many factors happening all at once. Changes in the requirements on the banking sector, which were necessary after the crisis in 2009, that led to non-bank financial institutions seeing opportunities for themselves because the regulations that were put in place in Dodd-Frank didn't affect them in the same way. We've also had rapidly improving technology, years-long low interest rates until recently. We had the pandemic. Those have all played a part, but so too has trying to apply an outdated regulatory framework, right? This framework we inherited from the New Deal to solve the problems of this larger unregulated financial system. So, for the non-financial corporate sector, companies that sell goods and services, we've seen a major shift in how they finance themselves, meaning whether or not they go through what you hear this terminology, an IPO, right, an independent public offering. We've seen a real shift in companies not starting to sell their stock on the open stock markets and stay private, right? And we've also seen these companies start to borrow from these private credit funds, right? The focus of what we're talking about today.